Hi, everyone. This is Yuman Sang from Turn Zero. Welcome to our webinar. We're just going to wait a few seconds for folks to come in from the waiting room. I'm glad you can join us. It's going to be a great webinar today. Good to see folks. It's going to be many hundreds of you at least on the call today. By the way, I saw 8 Brians already. So it's a big Brian day.
How many
Brians?
Yumans?
Let's see.
Yeah.
There's a West. I'm gonna go for Robs. How many Robs are there?
Yeah.
You know, it's interesting. My wife's name is Flynn, and my last name is Sang. Right, her last name is Flynn, and we did a comparison in the Mexico City phone book on Sangs versus Flynn's. Would you think, Rob, there were more Flynn's or more Sangs in the Mexico City white pages?
Huge city, big population.
City. Big
I
city.
have no idea. I have no idea.
Big city, more Sangs.
Okay.
Yeah.
Yeah. It's popular with expats and
Chinese people.
Yeah, I guess. Yeah.
Okay. Oh.
There you go.
All right, everyone. We'll just wait 30 more seconds and we'll get started. Hopefully it's a nice day for many of you all over the world and the country. It's a nice day for you, Rob, by the way.
It is a little bit of a June gloom here in Seattle. Kind of standard for us. A little gloomy, but not terrible.
All right.
Yeah.
It's actually really
pleasant.
perfect today. Yeah.
Nice.
All right. Well, hey, let's get started. Thank you everyone for joining. I'm Yuman Sang. I'm the founder and CEO of Turn Zero. By the way, just a couple things. This webinar is being recorded. If you have questions for either me or Rob as we go through the webinar, please go ahead and put it in the Q&A, and we will spend certainly a bit of time at the end going through our Q&A. And for those of you who are interested, we are recording this. You will get a link to this recording as well as a PDF of the slides tomorrow afternoon at the latest. So we will be sending those out tomorrow afternoon. So, you don't have to take screenshots. You will get a PDF of the file. All right. I am happy to be joined today by Rob Belcher. Rob's the managing director of SaaS Capital. SaaS Capital provides growth debt, and they designed explicitly for B2B SaaS companies. So many of you on this call are B2B SaaS companies. And if you use debt, it's often a very non-dilutive capital, very flexible, and really sort of part of the arsenal that SaaS companies use to grow. So Rob, welcome. Thanks for joining us today.
Thanks, Yuman. We've done this a couple of years and it's always great. We're really well aligned as lenders. We're focused on revenue and revenue quality. And so retention is front and center on that one. And so retention is a big deal, and tracking those metrics and knowing what's standard in the industry, what's the peer benchmark look like, and what are the best practices and ways to improve and all that kind of stuff. So this webinar is always one of our favorites to do with Yuman and the Turn Zero team every year, share our metrics and then hear what's new on the playbook for CS.
Yeah, I think this is our 5th year doing it, right, Rob?
Probably. I was thinking about that the other day. We've done it a lot. It's been a long time.
All right.
Time flies when you have a pandemic. So.
That's right. All right. I'll let you give a little bit, and then I'll chime in when I see something. Go ahead, Rob.
That sounds great. Yeah. So this is, we do a survey every year. I'm sure many of you have taken it, and thank you for your participation. We have a little over 1,500 companies take it just about every year. They run the gamut of pre-revenue all the way up to hundreds of millions of ARR, and very SMB up to very enterprise on the ACV side. They're global, but just through our work, the majority of the folks that we interact with and everything. So it's mostly US and UK, but it's all over. And so we ask a whole bunch of questions, and you'll see, so that we can segment data. For the purposes of my data today, a big focus is on revenue retention. You probably track all kinds of different ways of segmenting retention by customer, by industry, by cohort, whatever it might be. Our focus as lenders, again, is on revenue and revenue quality. So that's what we focus on. We also think it's super important for you to focus on is probably the top number also, because it drives growth rate, and then all of those things play into, valuation. Multiples are driven as a multiple of revenue. So, maintaining high revenue and growing revenue is valuation. End of the day, big importance. The calculation we use and we define for the survey for net retention is we do year over year, same cohort customers revenue. So what was your revenue in December? And this is for 2022, by the way. We send this survey out in Q1 of every year. So we just wrapped it up just recently in March. And it was on 2022 data. And so here's the example is what was your revenue in 2021? And then what did those customers only, so you don't get to count any new sales for 2022, but just what did those customers that were your customers in 2021, what did they do for you in revenue in December of 2022? For net, you include upsells, cross-sells, price increases, all that stuff. So that number can be more than 100%. For gross retention, you don't count any of that. It's just the core sort of subscription price. The best you can do is 100% on that front. So we'll walk into that. And that should be pretty common knowledge at this point. Hopefully that's a calculation you're familiar with. That's how we like to look at things. All right, let's jump into it. So the first way we like to slice and dice the numbers is by ACV, which might seem like a little bit of a strange place to start. But we think for retention, companies that sell a similar size product, price-wise, similar size pricing-wise, have the most in common. They're structured the same. They might be, smaller ACV customers. Companies probably are more focused on marketing, whereas 250K and more has probably got a larger sales organization. Definitely does some marketing, but is got a pretty hefty sales org, multiple tiers and things like that. So just those cost structures and the way you go to market, maybe channel partnerships. So we like to segment by ACV. And here's the data. First and foremost, the average, or not the average, the median, very important, across the whole data set is 102 for net retention and 91 from gross retention. And that's up slightly from prior years. It had been 100. Yuman's nodding, he remembers. It's been 190 for years and years. And so we're very pleased to see a little bit of an increase this year. So that's cool. So well done, everyone. And then we've seen actually a reversal in the trend here. So prior to about 2020, net retention was pretty flat across all ACVs at a little more than 100%. And gross retention was the one that had the trend line with ACVs. It grew linearly with ACV. We actually think that this trend that we're seeing this year and we have for the last couple of years makes a little more sense. Gross retention is sort of what it is. It is lower. It's a little bit lower for smaller ticket sizes, for more SMB, which kind of makes sense. Maybe month-to-month contracts, not as mission critical, right? So it might churn a little higher, whereas big chunky contracts of 100K, 250K are going to be a little stickier, maybe multi-year contracts, lots of contract negotiations and things. So it's just naturally more sticky. So that makes sense. And then the net retention, where there's a lot more upsell opportunity for larger ticket items, makes good sense to us. And so I don't have a great explanation for why it was the other way before, but we're happy to see this trend. And the numbers are, as you can see, quite a bit higher net retention for those larger products.
Yeah, Rob, I agree. By the way, if anything, I actually would have expected the slope to be, but I think the slope makes a lot of sense. I think that's what you're saying.
Yeah.
And if anything, I would imagine the slope ought to be even steeper. But it's good to see, right, that there's some normalcy on the trends.
Yeah, and this is median. So actually, that's a good lead in, Yuman. The next slide is actually getting into a little more of the what's the right term, like the outliers or the exceptional cases. And so this is net revenue again by ACV, but it's broken into quartiles. We have the 75th. The median, and then the 25th. And so you do see a little more of that sort of non-linear slope to the highest performers, the most exceptional on the net revenue retention. That gray dash is the 75th percentile. So those larger ACV products definitely have more upside on the NRR than the lower ACV. So that's the takeaway here is the compression on the smaller ACVs. There's just less. It looks like there's less upsell potential with smaller products, and there's a lot more on the larger side. The other interesting thing here is the floor. So even the 25th percentile are over 100% net retention on the larger ACVs and are above 90% on the smaller ACVs and above 95% for most of them. So I thought that was pretty interesting. Is this pretty high floor, some pretty close, most everyone's doing pretty great between the median and 25 percentile, and then the 75 is where you see the big opportunity.
I mean, that's impressive, don't you think? Especially on the lower end, right? If you can keep 100% NRR, less than 12, that means that, at least the respondents are doing very well. Good practices, I imagine. Yeah.
Yeah, and it's important. The time frame is important. This is over 2022, so we were pretty curious to see how things were. We're still kind of coming out of the pandemic. Things have stabilized. Just it's important to consider kind of what the macro world was like. And so I think these are pretty good numbers considering it was a sort of an okay year. Valuations came way down during the year, but I think performance-wise, companies did okay. Next slide is actually the same chart, but for gross revenue retention, and we see. Basically, the inverse is there's a ceiling, obviously, because gross retention can't be above 100. But again, so we've got a pretty tight compression between the best performers and even the median. So again, companies are doing pretty well, and then you do have quite a bit lower gross retention for that bottom quartile. But even those numbers aren't horrible, right? Even for SMB, 80% isn't terrible, and 85 is completely reasonable. For mid-size ACV, so sort of the inverse correlation from the NRR chart we just saw.
Yeah, I think GRR. I know as companies grow and develop in size, there's often a move from NRR to GRR, and so just getting really good at GRR, I think is an important part of a company's growth. So it's good to see.
Yeah. Okay. Great. And actually, I think that might lead into the next slide. Yeah, so this is by ARR, which is a little bit of a proxy for time. So kind of what Yuman was just saying is an interesting thing here. Let's start with GRR, actually. So GRR goes down over time, which is quixotic and a little bit opposite of what he was just saying. But we think that's because customers haven't yet had time to churn out yet. So when you're less than $1 million, that's sort of the 1 to 3 year period of growing your business, maybe a little longer, and you might have customers stick around for 2 years or 3 years before they figure out whether they like the product or not, and then they finally churn after the 3rd or 4th year. And so we think this downtrend in GRR to a baseline of 90 is just giving your customers and the product time to kind of sort itself out and figure out where it is and who the customer base is, who the ideal target customer is, etc. So exactly what Yuman was saying is a focus on gross retention increases over time at the company, but that's because gross retention is decreasing from those early, maybe overly optimistic metrics. And then net retention is it grows as companies grow, and similarly, just becomes a focus and a revenue line for companies. So they're really focused on it and trying to grow the business through the existing customer base. So we see that we work with companies with about 3 million to 30 million of ARR, and that's we get on quarterly review calls, and we're offering this product to offer to our existing customer set to grow. That's very common. So
I mean, sort of as a company gets bigger, oftentimes they are looking to sell more to their base, right?
Of course.
And they are developing more products, maybe doing some M&A to acquire new offerings. So it makes a lot of sense that NRR goes up.
Yeah, especially at that period, sort of now you've got sort of 30 to 60 employees, and you've got people focused on that kind of thing. So. Okay, great. The next ones are just some data for you, just different ways to segment the data. There's no real big message here. We've got it separated net and gross by bootstrap versus equity backed. And I guess the only takeaway I'd share here is these numbers used to be pretty different between bootstrapped and equity backed, and now they're pretty similar, a little higher for equity backed, especially on net retention. And we'll talk about that in a minute. We have some data on funding and capital efficiency. So, the story there might be, okay, those companies have more money to spend. They've got more CSMs or whatever that's focused on in-selling to the install base and all that. So that might make some sense. But the gross retention being dead flat between the two is interesting. And we think this is because of exactly this type of thing that we're doing today, which is talking about retention and customer management, because, maybe 5-10 years ago, it wasn't as well known. Folks like Yuman and Turn Zero have done a great job both with the product and sharing the best practices, like in a webinar like this, educating the market and improving the playbook and the best practices. And so everyone has access to that. It's been democratized, and now everyone has the CS best practices, whereas before it was, your VC board member might have been an entrepreneur in the past and knew these secrets or had been in the network and known these things and could share it with you. Now it's kind of everybody knows, and it's a little more commonplace. So that's a thought there. I don't know, Yaman, if you have any.
Yeah, it's interesting. I would have guessed, and it was true for a long time, that equity-backed companies would have higher NRR, more to invest, right? More dollars to invest, maybe access to, to resources. But I'll tell you that, I think equity-backed companies also, they have such a focus on new sales that maybe, they're getting maybe some bad fit customers that they churn out, right? So the benefits of having, VC money, right? Lots of salespeople selling, maybe, will reflect again sort of a better investment CS and versus a bootstrap company. So I kind of see that vertical versus horizontal. I think that makes perfect sense. I think vertical SaaS, they're so focused on the use case, right? Whereas horizontal SaaS, you're trying to like just be everything to everybody. Vertical SaaS, like, hey, landscapers, automotive, gross revenue retention being higher makes complete sense to me there.
Yeah, I agree. And it's interesting that the net retention between the two is pretty even. So, just it's sort of company independent is what that tells me. Yeah, it's great. Okay. I think we have one more slide in this section, and this is an interesting one. We did this, I think, last year for the first time, and that was segmenting retention by growth rate, or rather segmenting growth rate by retention. So if we look at different net revenue retention buckets, right? Here's your buckets of below 90, and then 10% increments up to 130. What is the median growth rate for those folks? And it was fascinating. This chart kind of surprised us, is that it really shows you the power of the compounding, and particularly when you're over 100%, that growth rates actually increase at an increasing rate for every 10 percentage points of net revenue retention you go up. And you can see, especially above 130, that's 30% growth right there that's baked in, automatic, and you only have to sell 40% new sales to get to 70% as a median, right? And so it's that outlier, and that's that flywheel, and this really displayed it in shocking manner for us.
It makes so much sense, Rob. A chart should look like this. I do have one question, right? So at the lower end, the left side of it, right, the below 90% NRR. Oftentimes those are SMB companies, right? So selling to micro businesses, they just naturally churn harder, right? So you're just not going to have the NRR. But those companies can grow like crazy as well. All right. So I am a little surprised to see how, that it's so steady up the chain. I would have imagined there's some, new sales being a little easier at the SMB side versus enterprise, where this takes a little bit longer. That would kind of even out a little bit.
I think a follow-on analysis here would be like a standard deviation for each of these. I wonder, or that sort of quartile analysis. I wonder if there is, the median is 20% growth, but there might be some really high outliers, to your point, like, Slack or any kind of product like growth thing that has this massive sales, but those are fewer and far between and harder to do. But if you find that sort of magic, bullet, away you go. But more of them have lower growth and higher churn. And then I wonder on the high end also, bigger ACVs, more of a narrow band between sort of the best and the worst at that mark. I wonder. That's a good point. That'd be kind of interesting to see the spread between all these. Again, these are just medians. And just last bullet on this one, gross revenue retention doesn't really have the same kind of relationship. It's more binary. 90% seems to be the break point between below median growth and above median growth. So if you want to be in sort of the top half of the peer group, you want to make sure your gross retention is above 90. Okay, that is the retention data update. Like I said, we asked some questions about capital efficiency and fundraising, and they do play into retention. We talk about retention in a second, and so we'll call back to some of this data here in a second. First, just a couple slides of just pure data from the survey, just news you can use. This is how many of you, what percent of the companies that responded have raised equity in the past and have raised debt. And so close to 30% are bootstrapped in the survey. And then you can see 31% have raised formal venture, 20% have raised, and this is predominant. So obviously, like kind of as you progress, your capital mix might change. So it's what's the most prevalent type of equity financing or debt financing that you've raised. So 17% have only raised angel, and then 31% have raised VC, 20% equity, and a few there have been invested in by strategics. And on the debt side, not nearly enough people are taking advantage of SaaS Capital. We've only got 44% have never raised debt, so something to consider. Bank debt's quite common. Venture debt or SaaS Capital, we consider ourselves a venture lender. We're a little different than standard venture lenders, but 18%, so that's quite a few. And then some of these newer models like royalty-based lending, and then what we call a subscription advance financing, like Piper, CapChase, are surprisingly small. They do a lot of marketing, so we thought that would be a higher percentage, but not as big as we thought.
Is this a new question for you, Rob? Is this a new question for you?
We have asked this in the past and not done much with it. And there's not, again, there's not much to do with it. There's no analysis really. We do use this. Sometimes we use this to spread different things, like what's growth rate by private equity-backed companies versus VC-backed, and certainly bootstrap versus VC-backed, that kind of thing. So we use it, but I, just wanted to share with folks on the webinar today the mix. So yeah, so this is a new question. Because 2022 was kind of a crazy year, and 2021 was different crazy, we wanted to understand if there was any broken deals, or if people were getting deals done, both on financing and M&A. So we asked this question of, did you try to raise money and succeed? Did you try and raise money and not succeed? Did you try and sell the business and succeed? Did you not try and sell or did you try and sell the business and not succeed? And then did you not do anything? So half the respondents weren't in the market at all. And then you can see here that nearly 30% went out to raise money, and they did. But 11% tried to raise money, and at least they hadn't done it by the end of the year. They might have closed in Q1 or whatever, but by the end of the year, they had not quite closed. Only 2% sold their business last year, which is kind of, that question's a little tricky, because obviously we're doing a survey of executives. Like if they're no longer at their company because they sold it, right? They're not going to do so. Who knows what that means? But the 7% that did not sell is kind of interesting. And then on the right here, we don't need to spend a whole lot of time on it, but this is the amounts of money that folks raise. If they did raise money last year, how much equity and how much debt did they raise? And the takeaways I'd share with you, let me make sure I've got this right. Yeah, this is from last year. The takeaway, and we'll talk about this leads into the next slide, which is on capital efficiency, is the ratios of debt and equity that folks have raised. And the interesting thing here is that generally speaking, folks, it looks like raised last year about 1x their ARR, maybe a little less, and about a third to a half their ARR of debt. Mm-hmm. And so you can see like a $10 to $20 million company raised 15 million of equity, and they might have raised 4 million of debt last year, right? So sort of 10 to 30% debt, close to 1x ARR. And that's pretty true across the board of ARR buckets here.
But the thing that's really clear to me about the slide on the right is that as the company grows, they start to favor debt over equity, right? I mean, there's a move towards debt, right? I mean, it's very clear.
Yeah.
Which makes sense, right? I mean, that's really what you focus on, Rob, right? Is sort of that mid-market, established good product market fit, right?
Yeah. Well, when you're small, you don't have, there's what collateral, as you get bigger and you have more revenue, more customers, there's more collateral, and yeah, it's true. Debt becomes a little more of an option for sure. So this leads us into capital efficiency. And so this is how many dollars have been, and this is only VC-backed companies. So we're looking at, no bootstrap companies. Obviously, their numbers are infinity because there's nothing invested, nothing outside invested. How many dollars of primary outside capital invested per dollar of ARR? And for most of these, we exclude companies that are less than $1 million to just focus on sort of like Iman just said, those larger companies where the numbers make a little more sense. The small denominator of the million, under million, kind of blows things out sometimes. So this first category is a little bit of an eye chart. I apologize. And we're going to do some analysis on this and do a big report that'll be a little more pretty, but wanted to get these numbers in front of you. Starting in the top left, this is by ARR, and no surprises here. Really nice trend to this is that as you grow, you need less and less money per dollar of ARR, like Yuman was just talking about. Obviously, when you're small, you have very few dollars, small denominator, and that flips over time. The rest of these are not, there's not as clear a signal through the noise. So I don't have a great story, but we'll share sort of what I'm seeing and what I'm thinking about. Capital efficiency by ACV, and Yuman, jump in at any time.
Yeah.
I'm a little bit surprised here. I don't know what I was expecting, but I'm pretty surprised that lower ACVs are lower dollars invested per ARR, and it's the larger ACVs that have the much higher capital efficiency ratios, right? And so are like full-blown enterprise sales teams more expensive per dollar of ARR? I guess that's what it's saying, right? Is you need more money. And which is like, we kind of love, we love businesses that are sort of 10K to 100K of ACV. They've performed very well. They have great metrics. It's interesting that it seems like the 50K to 100 is the most expensive to try and grow. I was a little surprised by that. Who knows? We'll track it year to year. That could just be some like irregularity in the data one year from the next, but there's a clear line between the smaller and the bigger. So
just for those who are new to this kind of capital efficiency conversation, lower is better in general, right? I mean, you're basically spending less investment dollars to get $1 of ARR. So for instance, if it's 1.3x, you spent $1.30, right? You burned $1.30 of investor dollars to get $1 of ARR. And so the lower it is, the more efficient you are. Now, I would say maybe a year and a half ago, Rob, no one cared about this ratio. Like people would calculate this ratio, but no one cared because the currency that was really important was growth at all costs. Today in 2023, I would say, this is a very, very important metric. And it should always be important, right? Like we were just out of whack for a few years. So I would say, as a company, you really do have to think about this. Those of you who are on a CS, how you contribute to this will be important as well.
Yeah, that's right. A couple, 2.5 years, their capital was free, and so it didn't matter. But capital is not free. There's a cost to it. So this really does matter.
Yeah, that really does. Right, capital is not free anymore. I think yes, absolutely.
It never really was, but it felt like it.
Right,
I mean,
right.
Just really quickly, you can see the growth rate chart here. Again, a little bit. There's no direct trend like a linear trend. My one thought might be that you're seeing higher capital efficiency ratios for the lower growth ones. Maybe growth never materialized. They've struggled. They've had to raise more money to try and keep the growth rate up. And it's not where they wanted to be. So we'll add more money. And it's, so that's an idea there. And that, the 30 to 70% growers are actually right in the sweet spot. Things they're hitting their plan. They've raised the amount of money they've wanted. I could be projecting big time here, but this is an idea of what's going on here. And so those folks have raised 1.4 to 1, right? And then interestingly, so this is where we'll tie it kind of all together. It kind of magically happened like this, but the 75% and higher growth rate, and down here on the retention ones, the higher retention, and then the 100K to 250K ACV are all the highest capital efficiency ratios. And you kind of can start to see the picture that they generate great net retention and they can generate great growth, but it's more expensive to set up those teams and that kind of thing and drive those sales and get it going. But they kind of all tie together. Yeah. Maybe that's kind of.
Well, I think growth definitely is, right? For most software companies, it's SaaS. If you are experiencing high growth, you're probably spending a lot of money to try to capture that ahead of time. And then the efficiency will come later. So makes a lot of sense.
Yep, you're investing in advance. That's right.
Yeah, absolutely.
That's what I had.
Well, that makes a lot of sense, Rob.
Yuman's got some great stuff for us here, but happy to answer questions at the end there.
Yeah, let's do a couple things. One is actually, let's do a quick survey here, right? So, I think one of the things you said, Rob, was like all of a sudden, things start to make a lot of sense. Retention is getting really strong. People have best practices. So I want to ask a question because, of course, 2023 is an interesting year. So the poll to everybody is, do you expect your company's 2023 retention rates to be better or worse than that in 2022? So that's the question. I think, by the way, I think you asked a question kind of like this in your survey, Rob.
Yeah, that's a good point. Kind of forgot it wasn't part of the data today, but it's something that's kind of relevant. While you fill that out, I don't want to share my results too early. Don't want to bias the sample here. But as you're filling out the survey, we did ask something. It was related. What do you see as the greatest challenge facing your company in 2023? But we gave them a set grouping of answers. And so new sales was the biggest one. 53% of all the responses were new sales. Raising financing was 10%. And then retaining existing customers was 9%. And there were some others like around recruiting employees and competition and stuff like that. But the top 3 and 80+% was sales, funding, and retention.
That makes sense. I mean, I think, if you have your customers, you feel like you can work on your customers. New sales, all of a sudden, if everything dries up, it does feel tough.
Yeah.
All right, Corey, let's see the results. Okay. All right, so I would say 40% better than 2022. And so therefore, 35% about the same and 25% much worse. You know what? I'm actually very surprised by this.
Pretty bold, about the same or better being whatever that is, 75%. That's pretty interesting.
Yeah, that's pretty impressive. I suppose we should have said gross versus net.
True.
I will say, the things that I'm seeing, Rob, is that I think gross is generally staying stable, right? So in other words, just kind of keeping your customers. But just like new sales has been kind of hard, I think net is harder, right? Because net includes expansion, and net includes selling more. And a lot of companies, fewer companies seem to be growing. And so I think maybe gross is actually staying fairly stable, but maybe net's taking a hit. So, I mean, that's what we're seeing a bit among our base.
Yeah, our portfolio companies. Yeah, portfolio companies are gross is fine. They're not churning, but sales cycles are elongating, and so are sort of those upsell opportunities are less exciting for customers now. So totally agree.
Yeah, for those of you who are actually seeing, sort of, maybe on the new sales side and maybe on the net revenue retention side, there's, this is things that's really lead to churn. And so let's go to the next slide. For those of you who know Churn Zero, we have something called churn monsters. These are sort of monsters that represent, I think, about 15 reasons, top reasons why companies churn. It's fun. It's a fun way just to kind of see, all the strategies and playbooks around churn. So go to our site and you can pick that up. We're introducing a new monster today. We're previewing a new monster. We're calling it headwinds. So headwinds is a new monster. You'll see it on our site shortly. But we wanted to preview it here because we're talking about that. Yeah. So just, look, that's a kind of a well, the monsters are kind of both scary and cute at the same time. So this is kind of a cute, scary monster, Rob. Anyway, let's talk. So headwinds. So the other thing I want to talk about a little bit is, sort of following on to I think we're talking about really CS maturing a bit, right? And then having those metrics that you've been doing for 12 years now kind of stabilizing and making a lot of sense, right? It's not weird. Everyone's sort of doing better and better. So I want to talk a bit about maturity in the CS. So let's take a look at that. In general, right? So I've given this webinar before, but I just want to focus on maybe where a lot of you are, right? So, if you're actually feeling like, hey, you got some stability in how you manage your customers, you probably have gone through the green stages. So that's build and operationalize, which means that a lot of you are now heading into transforming your CS and then moving into a leadership phase. And then at some point, moving on to optimization, or some of you moving into chaos, right? So let me quickly go through that. And by the way, as I quickly go through that, go ahead and hit your questions for me and Rob in the Q&A. So let's go ahead and hit this really quickly.
Just as a quick aside, that slide is exactly what I was talking about with the playbooks and the sort of, democratization of information. If you haven't gone back and watched any of Yuman's webinars that walk through the first half of this, like this is gold, right? Of setting up and getting your CS organization and best practices and processes in place. This didn't exist 5, 6, 7, 8 years ago. This is awesome.
Yeah, thanks, Rob. I mean, I think that's why people are getting better, right? So,
Yeah,
you
totally.
sort of
and
now
the retention
know,
rates are
okay,
improving. Yeah.
retention, exactly. And so let's say you actually feel like you're there. So let's talk about transforming. So I'm actually going to assume you've done the operationalize. So transforming really is now you're focusing on the customer driving more value into your company, right? And so it's not only servicing the customer, then the customers will actually even transform your company. So let's talk about some things that can happen. Often, what will likely happen here is that you have plenty of resources, right? You have knowledge bases, training resources, you have chat, you have community, you may have certification. It's likely, by the way, it's really everywhere, right? It's sort of scattered all over the place. And it's just sort of like products, become confusing as they grow, and you need a UX overhaul. You'll need the same kind of overhaul for your customer resources, right? So think about this. By the way, all of these things, will happen to you. It will happen to Turn Zero. It'll happen to every SaaS company because this is sort of the natural part of growing. So my point here is like these are things you have to focus on because they will be issues. So make sure you do that. The next slide. Let's go ahead. By this stage, also, right, you're probably getting larger. It used to be when you're smaller, everybody cared about the customer. And then at this point, you're probably more siloed, because and companies start to drift from their companies will start to drift from their customer base. So bring them all back in. You'll have to formalize it, right? You'll have to have internal webinars, maybe lunch and learns about why you win, why you lose, why you renew, why people churn. You'll have to set up, Teams and Slack channels where NPS goes into, and notes and product feedback and product reviews. Just be formal about, how you get this information into the rest of the organization. That's really important. Also, at this point, you'll see, how do I scale my team? And this is sort of where specialization starts. In the beginning, when you're smaller, you would hire a CSM. They tend to be do-it-all kinds of folks. They're kind of unicorns in that way. They're kind of heroes. Those unicorns and those heroes, there are just not that many of them. And so now you have to think about specialization. Oftentimes that can be like, it often starts with like onboarding, right? Onboarding, we have specialists for onboarding. And then maybe at some point you would have, oh, well, we're big enough where the CSM is different from account managers, where account managers will expand. And so, in this part of the transformation stage, you really are thinking about scaling the team. Okay, then, by the way, the sign that you have to level up to the next stage, right? So you think you're doing great as a CS leader, and you probably are. Guess what? New sales will start to slow because the company gets big, it's natural. And then the eyes turn to customer success for you to grow, right? And will be a lot of pressure on net revenue retention, which means a lot of pressure on on customer success, delivering growth into the company. So expect this, right? You are going to have to level up, and it's normally around this stage when you are being asked to level up. And when you are leveling up, that's when you hit leadership phase, right? And look, I'm very bullish on customer success. In some ways, I do have a horse in the race, but I will predict that the customer success team will be the most sophisticated of all the departments in the B2B company. Okay. And why do I believe that? One is that you have the business scrutiny, right? So just like new sales has a lot of scrutiny for bringing in new sales, CS has a lot of scrutiny to deliver on revenue retention, whether it's GRR or NRR. You're protecting the most important asset. And the other thing, by the way, is that you generally servicing a customer is very much more complex. I'm not saying it's harder, but I'm saying it's more complex than landing a new account, right? There's more pieces of data to deal with. There's more workflows, sort of in more degrees of freedom. So it's actually a more difficult problem. And I expect those of you to start the leadership phase. All right, what are the pitfalls when you're in the leadership phase? For some of you, you won't embrace the seat. Look, CS is still a relatively new department, right? So those of you, who are moving into the leadership phase, you may be doing it for the first time as a CXO or a VP. And it is,
presenting
it's
to the
tough
board for the first day, like CS actually being part of the board conversations, all that kind of stuff.
That's right. Yeah, I mean, basically, you are being given a seat at the table, right? Embrace it, right? You deserve it. What you're doing is important. Do not back away from it. I've seen too many people kind of shy away from that. The other thing that often happens, known pitfall, is that you've actually probably, haven't really built out your bench yet, right? So these are people, who are next generation VPs, next generation directors. The team has grown. You've grown together. You're a close team. But now it's, you really have to figure out who's the future leader. And you probably don't have as many of them as you think you do. So a known pitfall, it does happen. All right, so after leadership, there are probably two things you may want to think about. One is optimization. And let's talk about what optimization means, right? You have a really just a high functioning machine, and then everyone says, oh, growth is now we're thinking about profitability, right? So that's when you really have to optimize. So let's take a look at the next slide. One known pitfall with this is actually most CS leaders I talk to are not necessarily in line with profit margin goals, right? So you have to understand, what percentage of revenue can you spend? What's your percent of expenses? And, and what do you have to hit? All right. A lot of CS folks are asking for things. You should more understand your budget and then, produce within that budget. For those of you, actually, let's go back one more. I don't know for you, Rob, but generally what I've seen is that companies spend anywhere from 5 to 15% of their expense line on customer success, right?
Just pulling that up.
Yeah.
You made me think about it because I didn't include that. We talk about it sometimes when we do this webinar. Customer support and success. Yep, 5 to 10, 5 to 12% across the board.
Yeah. There you go.
And this is split by ARR. It's just our simple aggregated. So there, again, lots of ways to split it. ACV would be really interesting, as it's some folks might spend more with higher ticket versus lower ticket.
So I think the most important thing to note here is do not accept less than 5, right? Because you can't run your business that way. And if you're asking for more than 12 to 15, know that you're really asking for more than what is normally allocated for CS, right? Definitely know that information about your company and about the benchmarks. All right, another known pitfall is, guess what? Turns out CS has the most numbers, right? The most, they have so many numbers. In fact, a lot of the comments in the chat is like, what's ACV? What's the difference between gross, right? I mean, these are values that these are numbers that are still kind of being developed. We don't even agree on a lot of them. But anyway, CS has a lot of adoption numbers, retention numbers, customer value numbers, which then leads to a lot of complex analytics. You have a lot of segmentation. You have to embrace planning analysis. You have to be great at it. And if you are not great at it, you are going to hit a speed bump, a pitfall during the optimization phase. All right, the other phase you may hit is the chaos phase. So what is the chaos phase? Well, many SaaS companies in the chase for growth, you're going to have new products, new business models. You're going to have experimentation. You can have M&A. And, sort of once you hone in on a great CS go-to-market, guess what? It's going to be really chaotic. Lots of crazy things happen in chaotic. The known pitfall that I will tell you is that don't be close-minded about it, right? Your company is going to want to grow. Your investors are going to want to grow. They are going to experiment. They are going to make wrong decisions along the way. But be open-minded, participate in that growth. All right, and then lastly, we did of course had to talk about AI. Don't we have to talk about AI, Rob? We always have to talk about AI.
Yeah. Crypto? No, crypto's dead. AI.
Oh, crypto's dead. We can't talk about crypto.
We're going to talk about AI now.
Yeah. But there is really a challenge, a conundrum, an opportunity to think about it as what you will. But there will be pitfalls as well. I don't know what they're going to be, but maybe they're going to be a few of these things. So let's go to the next slide. So, basically unknown. Look, who knows, right? But at the very least, I think you're going to be asked for productivity improvements, right? Where's my 30% productivity improvement? Where's my 100% productivity improvement, right? These are things that can be conceivably be asked of you. Even people wondering, do we even need CES people anymore? Do we need SDRs anymore? Do we need salespeople anymore? I mean, these are questions that will be asked. They may feel kind of weird to ask them, but these are things that will actually shake up all our businesses in the next 12 to 18 years. I think we'll find an equilibrium, but we don't know what that will be. And then you may have some customers, expecting more AI-driven solutions. We'll see how that goes. Especially if your company is not investing in AI, there may be a lot of pitfalls there as well. Anyway, so this is sort of what happens next, right? These are things you can expect, as you sort of up level to this stage. So hope that was super helpful. Let's move on to Q&A. So before I get into the Q&A, we do also have another a survey. So for those of you, please go ahead and click on this link over here. We have another survey going on right now. And if you participate in the survey, you'll get early results. We ask a very different set of questions. The SaaS Capital survey is very much about really great metrics. We really focus more on sort of where CS is going. All right. All right. So some great
can
questions.
I jump in, Yaman? I actually was, while you were finishing up, I was taking a look at the Q&A, and there were a couple that are related that I'd like to that are super nuts and bolts that I can answer quickly, if that's all right.
Yes.
People were asking about the capital efficiency stuff, and I didn't explain it well. There was a number of questions like, well, what about companies just sitting on a bunch of cash they raised? Did they raise a we asked enough questions that we were able to determine amount of, so all of those numbers were actual cash spent so far. So it nets out cash balance. So it doesn't include like a big war chest still sitting in the bank account undeployed. It is only so far how much money has already been spent per dollar of ARR at the end of the year. So hopefully that clears up that question. And so that should be enough.
I do have there's one question I want you to answer. So basically, is there correlation between retention and contract duration? So do longer term contracts lead to better retention?
Yeah, generally, I think we don't have any data on it, but from experience, and you tell me too. Yes, we found that companies that have 1 to 3 year contracts have great retention. Especially if it's the ACV's large enough that they have a rolling, once you start selling more things, companies that are up for renewal. We've actually seen a number of borrowers start calculating retention as a percentage of dollars that were actually up for renewal. How much was retained, not just on total base, which is what our numbers are on. So yeah, absolutely. It certainly helps. If folks aren't happy, they're going to churn, but longer contract, more time spent negotiating, more buy-in from the customer, probably more implementation, all those things help.
Yeah, and then I think the corollary to that, and this was also part of the question, is longer term contracts are harder to sell. So many things you sort of weigh, the velocity of new accounts coming in versus the retention, right? Big deals, long-term contracts will just simply be a bit harder to sell, right? So you're really weighing the costs, the pluses and minuses. Rob, you may have a question answer to this one. What ARR? Let's just focus on ARR. What ARR range do you see startups adding customer success? When do they add customer success?
Ooh. I don't have a great answer because we work with companies with 3 million of ARR and up, and most of them at that point have at least a person. So it may be pretty, early days, but most folks have at least, definitely support and probably at least like a head of CS, if not, 2, 3, 4 people at that stage. So I
will quote Jason Lemkin, the godfather of SaaS. He believes that customer success is a single digit hire, which means that they're employee 1 through 9. 1 through 9.
Wow. Okay. Yeah.
And that's because like someone's you're going to build a product and then you're going to get your first customer who's going to deal with that customer.
Right.
Maybe it's the founder, right? But I think I actually do agree that there's a difference between getting a CSM, doing the work, and then having a department, that's more formal. But I would say, you sort of formalize a customer success function when you have product market fit, right? I mean, and so you're feeling like you're getting customers at a good enough clip, where then you can then have a process for servicing them, making sure they're adopting the product, onboarding them correctly, and then retaining them, right? And I generally see that anywhere from about $1.5 million to $3 million of ARR. All right, let's see. There's a lot of questions here.
While you look
Yeah,
through
go
for our
ahead.
next one, I saw a couple again that were talking about price increases is possibly buoying up net retention rates, especially last year, kind of inflation and all that stuff. We actually asked that. That was another question in the survey that was for that very reason. 43% of respondents did no price changes in 2022. Almost no one dropped prices in 2022. And the most common, 17% did 0 to 5% price increase, 20% did 5 to 10%, and then single digits did more than 10%. Single digits in each of the buckets. So a total of 13%, I guess, raised prices more than 10%. So a little bit of an increase, kind of in line with inflation. 7-8% was pretty common.
All right. All right. So I want to ask, how do you explain the difference of a account manager with a quota and a customer success person to a CFO that has not worked with a SaaS company before joining the company? What's the difference between an account manager and a customer success person?
What's your question?
Yeah, that's my question. So account manager tends to worry less about adoption of the product, right, or successful onboarding. I mean, they do care, and a CS person really, in the name, right, is the customer being successful, right? Not as the customer buying more from you, it's the customer being successful. And so historically, account manager has been more about the business side, and the CS person has been historically about the customer satisfaction side. Now, early on, oftentimes that's one person, right? And then, sort of as you grow, there's specialization. So I think that's really important. Okay, so what metrics or data do you suggest that you use to prove or report on productivity improvements after beginning to operationalize? So what are the metrics that, if somebody says, hey, I'm investing in customer success, I'm investing in, a technology, how do I prove productivity? Is there something that you would focus on? ARR, right? Like net revenue retention? Yeah.
Yeah, for sure. I mean, I think, it's really table stakes these days to have very clear your growth rate, very clear your net retention rate, very clear your gross retention rate. The only time that we sort of give a pass to folks is if they are SMB and they have tons and tons and tons of customers. But at some point, not to do the plug of the commercial for Turn Zero, at some point you're going to need a platform. It blows up a spreadsheet, right? And so you need to be able to present it at some point. And so those things are just table stakes. And then I think as you grow, this goes to the leadership and the specialization and all that, building out your team. You're gonna need metrics on individual sub-industries of your customer group or sub-size customers, or maybe this product module, all kinds of stuff. So, very early with the the single digit hire that we just talked about, you need to be calculating NRR and GRR for sure. I don't know if that answered the question or not.
Yeah, let me actually take a shot at it as well.
Yeah,
but while I do it, why don't you look for a question to answer?
You guys, good questions so far.
Yeah. And so, look, what are the metrics that I think prove out, the investment in customer success? I think if you start at the very end, and the very, very, very end is the net revenue retention, right? I mean, that's really the holy grail. One before that is probably gross revenue retention. And then you start working on things like, NPS scores, right? Because if you are being more productive, you should have higher NPS. And then even before that, like all the things that lead to that would be, what's the book of business is, that each CSM handles? Is that getting bigger with your investment, right? Because if you're investing in technology, investing in training, normally you would expect more efficiencies, and oftentimes that means a bigger book of business. And then, that you can also look at tasks, of meetings, calls made, right? Because if you are getting more efficient, better plays, better best practices, you would expect those types of activities to also increase, per CSM. So some of the things for you to think about. Start at the very end, and then you can get closer to activity level.
Okay. Here's an interesting one. It's probably maybe more for you, or we may not have an answer for it, but it's a question more about compensation and kind of thinking about NRR and churn in your. It's more on sales team is the question. Is comp plans for NRR on the sales side of things now that new business is slowing a little bit, and so are folks reworking their comp plans for sales to try and have NRR kind of as a stronger component of new sales. The only thing I'll say there is, and then Yuman, if you have more to add, most folks that have, we know most folks have some sort of tail on the sales comp plan for upsells, a small percentage. The CSM gets the lion's share of that. What am I trying to say? The bonus. I'll just call it the bonus. I forget what the word is. It's escaped my mind. But the salesperson might have a tail, and then there's also tails on multi-year deals too. So they would still get comped on a second year or a third year of a customer that's either renewing or that has a 3-year contract too. So those are important.
So Rob, is the question about new sales more than it's about
it
CSM?
is, especially
right?
now, new sales in today's environment
Right.
where sales are slowing. Is there a shift in focus to try and comp people on good customers that will upsell as a way to drive, drive revenue growth?
Yeah, I do see comp to new salespeople happening in certain situations. Two in general. One is if your product is a natural land and expand product, right? In other words, the first thing you sell is often very, very small piece of the entire thing you ultimately would sell. I mean, maybe I'll use the example of Slack, for instance, just so everyone knows Slack is that generally it's like one small team that started using Slack in the beginning, right? It'll be like the engineering team picked up Slack, and then at the end of it, the whole company is using Slack, right? So that's a land, and then it has to expand. And so therefore the go-to-market motion is very much, selling when you go from one team to another. So I see that, as a retention and renewal, the expansion. The other time I see it is that if a company's having a lot of problems with bad fit customers, so new sales just selling to customers that are just not a good fit for the product or service that you have. And so, it's incentivizing new sales not to do that. Those are the two, most common places I see sales being comped by NRR. Here's a question that maybe you can answer, Rob. Did higher interest rates in 2022 and maybe 2023, is that affecting attempts to raise debt funding? Is that hurting folks?
So this is more of a sort of market overview. So I'll give a quick sort of market status. You may have heard that the 2 largest banks that serve software companies collapsed in March. So that's also, add that into the mix. If you haven't heard, Silicon Valley Bank and First Republic and Signature all collapsed in March. And Silicon Valley Bank is the largest venture debt lender by a huge margin. They did $70 billion of venture loans. We have a $100 million fund. So generally, there's a bunch of stuff going on. One is headwind monster has showed up a little bit, and so companies are generally less focused on growth at all costs, like they were in 2021 and a little bit of 2022. So cutting to be more profitable, more break even is happening. So less need for fundraising. Valuations have come way down, so folks are disinclined to raise equity. Interest rates have gone up, and so folks are disinclined to raise debt. So I'd say generally folks are slowing down fundraising. Our deal flow has stayed about the same through all of this, and part of that is Silicon Valley Bank exploding, and so there's a lot of those customers that are looking for a new home, even though there's no crisis there, but they just aren't sure and they want to have more stability. So we're seeing some deal flow from that. But in general, just our value prop, especially now that equity is expensive. So folks, even though we've raised our rates a little bit, not to the same extent as treasuries, but we've raised it a little bit, but our value prop is even more valuable now because equity is, 3 to 4 times more expensive than it was. So I hope, that's, I could go on forever and ever talking about the industry, but hopefully that gives you a snapshot of what's going on.
Well, I do think, debt and equity are really 2 great ways to invest in the company. And, some days, equity is in favor for certain reasons, and other days with debt, I think this is really a day where, it's at least balanced, if not favoring debt. So, hit up
If you
Rob
have a
if you have
big, if
needs.
you have a really big opportunity and you need to gobble up market share quickly or build a really big product really fast, I think equity is a great tool. That's what it's for. It was originally designed to build silicon wafers, factories to build silicon chips, right? That's a huge capital intensive thing. If you just need a couple $1,000,000 to grow sales, right? There are other alternatives. That's my obviously biased view. My last comment on the market, I do want to mention, because I also saw an article from Dan Primack. He's great. You should, if you don't subscribe to his newsletter, you should. It's just good deal, sort of tech deal stuff all the time. He was talking about the M&A market. We've seen the exact same thing. We just had our first exit in our portfolio in over a year. Normally we'd have like a company sell or raise equity or private equity and kind of exit our portfolio at least once a quarter, if not once a month.
Wow.
And we just had the first one in a year. So the M&A market was like shut. And now I feel like it's thawing. And he said in his newsletter recently too, that it's thawing a little bit in M&A, and even IPOs might be coming back a little bit too. So who knows?
Oh boy.
What the last half. Yeah.
Here, you heard it here first.
That's right.
Well, let's end there. That's a nice bright note. And we're on top of the hour. Lots of questions. Maybe we can answer it in a Q&A blog or something like that. But Rob, thank you so much again for doing this with me.
Yep.
And
always fun. Thank you,
I will see you next year, right, Rob?
That's right.
At the very
of course.
least. Okay.
Yep.
All right. Thanks for everyone for joining. It was great, great group. Very engaged.
Great questions.
And and then by the way, we will send you a recording with the PDF of the slides. So thanks everyone for joining. Talk to you soon. Bye, Rob.
Take care. Have a great day.